So in terms of the client's business risk, what the client's business risk does, again, is it focuses the auditor on, the auditor is going to think about it from the perspective of, well, how might these risks manifest in the financial statements? How might these risks contribute to the risk of material mistake or influence the risk of material misstatement? Management is responsible for internal controls just as they're responsible for the financial statements. So management has to sign off on the financial statements, and they also have to, they make a statement about the financial statements. There's accountability, and that's created as a result of SOX, that they certify that they have a system of internal controls, and so that they can't kind of hide behind that, oh, well, we gave that work, we assigned that work to the controller was responsible for that. Well, no, you're the CEO and the CFO, you're responsible for it. You have accountability, so it creates accountability for management. And then the auditor's primary control, obviously, is the risk of material mistake. Right? They're concerned that the financial statements contain a material misstatement, and they want to make sure that their audit, that the audit opinion is consistent with the fact, and they give a clean opinion that there is based on the fact that it's not a material mistake. They don't want to blow the audit opinion. Analytical procedures at this stage, at the planning stage, we call them preliminary analytical procedures, and the reason they're considered preliminary analytical procedures because they're attention directed. Right, they're meant to direct the auditor's attention to possible misstatements in the financial statements so that the auditor is able to adjust their audit procedures in those areas. So you've all taken financial accounting, so you've all seen ratios and you perform those ratios, right? You know how to calculate ratios. Auditors know how to calculate ratios. But what they're concerned is, what are those ratios telling you? So it helps auditors, the auditors, based on their understanding of the client's business, industry, their entity, helps them set expectations. And they're going to compare the results of those ratios against their expectations. So for example, if you have a situation where, and I think I might have used this one before, where revenue or sales are on a downward trend, but we see an increase in accounts receivable. Well, based on the auditor's understanding, right, if they understand that, okay, this is occurring during a time of economic downturn, right? So we expected this client's revenue would decrease, and we know that because their customers are hit by this, right, that management has already told us that they changed their payment terms. So they gave their their customers more time to pay. So then that relationship makes sense based on, and the auditor set that expectation based on the fact of their preliminary planning, right, their understanding the entity. That does not mean that they don't look for other reasons. So one of the things they might do is look at, okay, well, what are we seeing in terms of collectability? That doesn't stop them from looking or prevent or suggest that they shouldn't dig further and look to make sure that it's not a collection issue, but that the issue is really customers are paying in the time period that even though the client has extended the payment terms, that the customers are still paying in that time frame, and it is not an issue of allowance without tax where they're not collecting. Right? So the expectations that the auditor sets are only as good as their preliminary planning procedures, where they're assessing the client's business risk, looking at what's going on in the industry, as well as other external factors. So there are some basic analytical procedures that auditors will perform, not only the analytical procedures that or ratios that you learned in the financial accounting class, but they might also, the first thing the auditor is going to do, they set a financial statement, they're going to look at this year's trial balance or unaudited financial statements, the results against prior years, just to see if anything that jumps out that says that doesn't make sense. Why is cash all of a sudden so much higher? Or why is cash so much lower? And what does that mean in terms of their ability to meet their operating expenses? Okay, so you want to look at the cash flow statement. See if there's some issues with their ability to meet, their operating expenses, because if it suggests that there's a problem with meeting operating expenses, well, maybe is this a going concern issue? Comparison of current year account balances to anticipated results. So the company has, budgets and forecasts that they make. Look at that. Looking at the relationship of accounts, as I gave with the example of accounts receivable to sales, right? You would expect that they're moving pretty much in the same direction, and if they don't, then you're going to look into why. What's the reason for that? Looking at ratios, looking at non-financial information as well, right? And to see, because non-financial information can be informative about, as I pointed out, the information that's reported in financial statements. So we talked about my example with Home Depot, right? We've had a financial crisis, we see their revenue go down. What other things are going to be impacted by that? But what is going on if we break their revenue into segments and see what segments of their business where we're seeing a downturn? Is it, their normal kind of store traffic for weekend home do-it-yourself project, or are we seeing a bigger decrease in, bulk buying from businesses, from their corporate accounts? So looking at statistics, non-financial information, or business statistics, and helping the auditor about on his business. So let's do a couple of knowledge checks. So related party transactions are they're not arm's length transactions. So that's if in the company, I own a pharmaceutical business, but then I also, a part of the company, there's a consumer products division. And so if the consumer products division sells supplies to the pharmaceutical division, that's a related party transaction, because it is not revenue that's earned outside of the company. Because when you consolidate, you have to eliminate. Did you guys say consolidation?
We're doing that.
Yeah. When you consolidate, those types of things go away, because that's not an arm's length transaction. It's a transaction with yourself, basically, right? So that's an example. The correct answer is D. So no one really said, well, interviewing internal auditors about it's not, because it's okay. Because when you're trying to identify transactions that are not arm's length transactions, and then transaction with a member of the company, or like the board, or with other companies in the divisions or things like that, they're not. When you consolidate, those transactions go away. And the safe answer is D. Right, you have to do all of those things, right? You have to talk to the audit firm, evaluate the integrity of management, assess the firm's resources to ensure that that you can do it. So all of the above. Let's look at another one. Answer is D, right? A scope limitation, because the scope limitation means that you're not going to be able to audit something, right? That you can't audit it. So yes, the correct answer is scope limitation. So what I want to do now is switch over to a problem, right? We talked about the Toya Central case. So you should have read the case already. And just kind of next to your seatmate, let's spend about 15 minutes just kind of review, identifying where the business risks are, right? And then thinking through, for those business risks, what's the potential financial statement impact? So the Toy Central Company, which was, you should have it because it was